We will now start with AS number 2, valuation of inventory. Valuation of inventory. Let's see here. Under accounting standard number 2, we are going to understand the valuation of inventory. How can we measure its true value? Inventory could be of 3 stages: raw material stage, finished goods stage, as well as work in progress stage. Apart from that, there may be some common stocks may also be available. Others like consumables, fuel, oil, or some other material may also be kept. All the 4 items are going to be covered under AS number 2. How can we value the raw material, work in progress stock, finished goods stock, and other items? We'll see some illustration, and then the valuation is clearly given here. This is the format. I'll explain this format later on. Let's start with some illustrations. So once cover the illustration, and then we'll summarize that as a theory with this one later on. Right. Now, how can you value work in progress? Work in progress. Usually, as per the AS number 2, the value will be taken as whichever is lower of actual cost you spend for making it. If I sell, what will be ultimate realizable value I will get in my hand? Between these two, whichever is lower will be taken as the value of the stock. Cost of the partly finished unit at the end of 21-22 is 150. This is nothing but cost of work in progress stock. Cost of work in progress stock. The unit can be finished next year by a further expenditure of rupees 100. Unit can be finished next year by a further expenditure of rupees 100. So additional cost. Currently, it's a semi-processed form. As on today, I manufactured at a cost of rupees 150, but cannot be saleable. It's a semi-processed form. I have to incur another 500 rupees to sell. The finished unit can be sold for 250. Sale value being 250, subject to a payment of rupees 4% brokerage and selling price. So you have to pay for brokerage. The brokerage being 4%. How much is that? 10 rupees. You'll get only 240 as net realizable value for the finished goods. NRV of the finished goods. But here the cost to be incurred for manufacturing this semi-processed good being 150. So this is nothing but work in progress stock, not completely finished stock. Okay. By completing and selling, you'll get only 240 in your hand. But for completion, you have to spend how much? Another 100 rupees. Okay. Further cost to complete. Further cost to complete. Then what about the NRV of the work in progress stock? This is what about the ultimate. But it is not finished goods. It's a semi-processed goods only. As it is being the semi-finished goods only. Okay. So you have to adjust the cost or NRV for the finished goods to semi-finished form by subtracting the additional cost you incur. So in case of NRV for work in progress stock, you can understand the sale value of finished goods minus expenses for sale, expenses on sale like brokerage, whatever it may be, and minus expenses you're supposed to incur to convert the work in progress state to finished goods state, whatever it may be. The ultimate value is nothing but NRV of work in progress. What happens, sir, in case NRV for finished goods, sir? It's very simple. Sale value of finished goods, okay. Sale value of finished goods minus expenses on sale. Expenses on sale. If you subtract, then the ultimate value will be considered as NRV. Okay, make a note of it. So in this illustration, the NRV of work in progress being 140, between these two, whichever is lower will be the value of work in progress stock. Work in progress stock. Assume that the partly finished unit cannot be sold in semi-finished form. So you cannot sell at the semi-finished form. You have to finish off. To finish off, you have to spend another 100 rupees. Final sale price 250. For that, brokerage 10 rupees is payable, means NRV being only 240 for the finished goods. But you don't have the finished goods. To convert that work in progress stock into finished goods stock, you have to spend another 100 rupees. That 100 rupees can be subtracted from 240 to find out the NRV for the work in progress. Okay. And the NRV is 0 without processing it further. Without converting the work in progress into finished goods, it will have no revenue generation at all, right? So now the value being 140. Now, how can we handle in case of fixed overhead, sir? For cost determination. For cost determination, you have to understand we have two types of costs: variable cost and fixed cost. Now, how can we add these costs to the cost of production? If the cost being the variable in nature, based on the actual number of units produced, you can divide the overall cost and add to the cost of production. For example, the variable cost being 1 lakh, actual number of units produced being 10,000, and variable overhead per unit will be considered as rupees 10. In case of fixed, you have to consider whichever is lower of actual production capacity or your budgeted capacity or capacity. Clear? See what happens now. If you join in Singar Academy, we need to offer free courseware, right? Courseware cost depending upon the number of students presenting here. Okay, then it is variable. The cost will be varying as per the number of students are attending. But what about the fixed cost? The rent and electricity charges and all, administration charges, that remains constant. Even if I have one student, I have to incur those costs. If I have the full capacity also, I need to spend the same money. If I get over admissions, for example, we can accommodate around 50 students. I got only 40 students, or I may get exactly 50, doesn't matter. If I get the admissions more than 50, I have the extra seats arranged within the same classroom. The fixed cost being, say, 1 lakh remains unadjustable. Student. How can I fix the sale means fees? If a student joins, material cost is equal to 2,500. What about this fixed cost, sir? 1 lakh. Okay. If I get only 40 students, or if I get exact capacity, then 1 lakh divided by 50. What is the number here? 2,000, am I right? So for the fixed cost, I need to add 2,000 rupees extra to recover from you. If the number of students admitted here being 50. If the number of students admitted being 40, what happens, sir? 40, what happens? Is that okay? In case of 40, 1 lakh divided by 40, 2,500. Material 2,500, fixed cost 2,500, 5,000 will be the cost. Here 4,500, here 5,000. I just make a slight correction here. Whichever is lower, no, it's whichever is higher will be taken. Whichever is higher will be taken. Clear? Now, if I get 60 students, what happens? How can I divide? Will it be 1 lakh divided by 60? 1667. 2500 for the material cost and 1667 for the fixed cost. 4167 will be the value. But here the main problem is, if the number of students admitted is less than 50, I have to divide this by 50 only, original capacity, or between these two, whichever is higher will be taken, whether it is 50 or 40. 50 is the actual capacity, sorry, your planned capacity, 40 is the actual capacity. I can accommodate 50 students, that's the capacity of Singar Academy. I got only 40 students admitted. So that's what the actual. So what number will be taken for calculating the fixed overhead per student? Actual, budget, whichever is lower, higher will be taken. So whichever is higher means 50. 1 lakh divided by 50, 2000. So this one is incorrect. So 2500 for material, 2000 for fixed cost, 4500 is logically correct. Suppose you think over, if I get only one student admitted, will I be able to charge 1 lakh divided by 1 lakh rupees? Material cost 2500 sir. Fixed cost 1 lakh, pay me 1 lakh 2500. What will you do? You don't join Singar Academy. Am I right? It's logically. If I tell you, sir, the entire capacity is built for you only, that's why I'm spending so much. See AC, see the classroom. The first 1 hour you sit in the first row, second 1 hour you sit in the last row. What will you do? So, no, sir. Even you can teach in your own personal room. I will sit nearby and learn. Don't spend even single penny for the fixed overhead, sir. Charge me only 2500. Am I right? The capacity is a decision of the management. It is not a decision of the customers. So it cannot be thrust to the customer's head. Okay, that's the logic. If the number of students admitted less than the actual capacity we planned for, we can divide the fixed cost based on the actual capacity and charge a lower value. Though I admit only one student, I had to divide that entire 1 lakh fixed cost based on the my capacity being 50, 2000 will be for rent. Sir, 1 lakh you paid, sir, you recover only 2000 rupees, 98,000 you lost. Yes, this is what about the loss due to the planning. It's my planning. Why do I want to establish a big center? Like if the number of students admitted is only one, you can plan. That is a logic behind. That's a logic behind. So as per this provision, cost can be classifiable into fixed cost as well as variable cost. Fixed cost is based on the actual number of students admitted or actual number of units produced. In case of fixed cost, whichever is higher of actual output and your capacity. Is that okay? APC Limited has a plant with a capacity to produce 1 lakh unit. This is what about the capacity. The expected fixed overhead being 18 lakhs. Find out the value of the stock if units produced are. This is what about the actual unit produced. In the first case, 1 lakh is the actual and your capacity being 1 lakh. What do you have to do? Between these two, whichever is higher will be taken. So here fixed overhead divided by this value. Okay, whichever is higher of actual or capacity. In the very first case, both are matching. So 18 lakhs is the fixed cost divided by 1 lakh. 18 rupees will be the fixed cost per unit. In case 90,000 only produced, then you still divide that by 1 lakh. Okay, then also 18 rupees. But if you are producing more than that, 18 lakhs, then take 1.2 or 1 lakh, whichever is higher, 1.2 will be taken. 18 lakhs divided by 1.2, the ultimate value being 15 rupees per unit. Just think over, Singar Academy capacity is 50, but we got 60 students admitted. Then what happens here? I have to arrange some extra chairs and all to accommodate you here. The venue seems to be cramped. The students will feel the facilities may be lesser. You demand some discount. Okay, automatically the over capacity leads to lower price. That lower price benefit should be given to the students. Clear? That's the logic behind. That's how you can calculate here. Hope now you'll be able to understand this one. If it is clear, text me. We'll move on to the next one. Now, in case of retail method of valuation, usually this method will be suitable for finished goods. A trader purchased, in this case, how can we calculate, sir? Opening stock plus purchases minus sales to get the closing stock. Sales to get the closing stock. Is that clear? Now you have to show at what value? At sale price. At sale price. Then finally you will get the closing stock at sale price. From there you have to subtract the profit component to get the closing stock at cost. This will be the second component. GP on stock. You have to subtract. This is the format. You know that opening stock plus purchases minus closing stock will be the sales, or if I subtract the sales, I will get the closing stock. In case of number of units, no problem. In case of cost angle, you will get the cost of goods sold, no problem. Isn't it? Opening stock plus purchases minus cost of goods sold. Then you will get the closing stock at cost. But here we are going to show all this value at the sale value. Then you will get the closing stock also at sale value, but usually we'll record the stocks at the cost only. So from the sale value of the closing stock, remove the profit to get the cost value. Is that okay? A trader purchased a certain article for rupees 85,000. Purchases. Okay. This is cost. He sold some of the article for 1,05,000. The average percentage of gross profit being 25% on cost. On cost. Opening stock of the inventory being 15,000 at cost. These things at cost. But I need to know at the sale price. At the sale price. Opening stock plus purchases minus sale. And you will get the closing stock also at the sale price. At sale price. After that, you have to convert this into cost. This will be the next block. Anyhow, here I have been given the cost. I cannot take this value. What is the GP here? 20% on cost. Cost is 15, so I have to add 25%. Now, if I add the 25% with this, what is the value you will be getting for the opening stock? 18,750. 3,750 is the profit, is added with 15,000 to get the opening stock at sale value being 18,750. Similarly, in case of purchases, 85,000 is the cost. You have to add 25% profit on that, so which is 42,500. 21,750. 250. Come on. 85 into 25%. 1 lakh. See, 1 lakh. 1 lakh. It's a problem with the calculator. That one is correct. She got confused. That's why I'm talking. Okay. See, I have to explain all these things for you. Standard. If it is 25% addable means you have to find out 25%, and then you have to add with this. You use your non-scientific calculator, you will get the value differently. 85,000 into 25 percentage equal, then plus you'll get full value. But here it will not get. The calculator in computer will be calculating differently, but in your non-scientific calculator you will get full value. Are you getting this or not? Yeah. See, if it is plus 25 means you calculate 25% and then it will be addable with the original value. Okay. Now what's the ultimate value here? 18,750 plus 10,000, sorry, 1,06,050, 1,25,000. From there, 1,05,000 is subtracted. You will be getting the closing stock at the cost, at the sale price. If the cost being 100, profit 25 is added, and closing stock with the sale at sale price being 125. 20,000 is nothing but closing stock value at sale value. Then what could be the profit component? 20,000 into 25 by 125. 4,000. Am I right? Then closing stock at cost being 16,000. This is the method you have to calculate. What you have to do in case of retail price method? Opening stock plus purchases minus sales. All these things are calculated at the sale value. Then you will get the closing stock at sale value. You remove the profit from there to get the answer. Why not this way, sir? Opening stock 15,000, purchases 85,000, overall value being 1 lakh minus cost of goods sold. 1,05,000 being the sale value. To find out the cost of goods sold, you have to remove the profit. So which is 25 by 125. 21,000 is removed. Okay. If I remove this, 84,000 will be the value. Is that okay? So this is 1 lakh and 84,000 is removed. So then you will get what? Closing stock 16. You'll get the same answer. But the format that you have to follow is this one. Because you will be showing all these things in your trading account at sale price only. Retail price method. Retail price method means the price at which it is traded in the market, from there GP is removed. I am not aware about what is my actual cost. I never refer my actual cost. If I am able to find out the actual cost, okay, but I never go for that. I am going to compare the retail price, from there GP is subtracted. From there GP is subtracted. That's the logic here. Clear? If it is clear, text me. We'll move on to the next one. Now, we'll deal with joint product and byproduct concept. Joint product and byproduct concept. Now, joint product and byproduct. In a common process, by the end of the process, you may get 2 or 3 products as output after the process. All the 2 or 3 products will have the equal importance in the market, then it is called joint product. From the crude oil, after the first process, refinery process, you get the petrol, diesel, even white petrol also be refined, and sweet petrol. There are lots of variants you are getting. The common process, converting the crude oil using the refinery process to the normal petrol and all. Okay. Immediately after the conversion process, refinery process, you get 3 or 4 different varieties of material. Okay, you will get the white petroleum jelly and the tar. You know, white petroleum jelly. How many of you heard about white petroleum jelly? In my college days, no. So I usually go and do some like soap and other things manufactured by ourselves. Myself and my cousin usually travel here or there. The soap powder and all will make. For one component, we are in need of white petroleum jelly. We travel down to Chennai, especially Nainiyappan Naikan Street. I think so. Still, I could remember the date and the street. It's very famous. I went there and purchased the white petroleum jelly. It's very dead cheap. By the time it's 30 or 20 rupees only. Now it may be around 100 rupees white petroleum jelly per kg. Maybe I'm not aware about the exact price today. That white petroleum jelly, 1 kg, assume it's a byproduct of the crude oil is equal to 100 rupees. Very cheaper. It's still cheaper. I'm not aware about the exact price. White petroleum jelly. Later on, this white petroleum jelly packed in 10 grams, 100 grams pack, 50 grams and 100 grams pack. And the 50 grams, 100 gram pack, they sold for 20 rupees. 100 grams, 20 rupees or 25 rupees, then 1 kg, it may be 250 rupees. But they gave the name for this packed material, which is called vaccine. Vaseline. Later nowadays, slightly they added the fragments and other named as lip guard, that 2 gram and 3 gram or 5 gram becomes 50 rupees. Also a product of Vaseline only, that the white petroleum jelly. In the common process, you get lots of product like petrol, crude oil, tar, and even benzoyl, and even this white petroleum jelly and all. All these things having equal importance in the market. If all the items will have the equal importance in the market, while processing we spend, say, 10 lakhs. Now the question is, out of the 10 lakhs, how much is meant for this one, this one, this one, this one? Segregation of the common cost you incurred for common process for various outputs after the end of the process, which is called split off point. You will study all these things in costing paper. No need to worry about that. Costing paper. Costing paper, we have the deep calculations, process costing check, right? Here, just understand. Okay. In accounting standard, how can you value is defined? There we will be studying in detail. Okay. Process costing and the joint product, byproduct. If all the products are having the equal importance, the joint cost you spend up to the point where you are identifying the segregated item, that is called split off point. This is called split off point. Okay. How can you segregate this 10 lakhs to these things will be studied here. Clear? Suppose some product may not be having the equal importance. After the process, okay, product A, product B, product C. Okay, rupees per kg. A saleable at rupees 100, B saleable at 150, but C saleable for just 5 rupees. So, after the joint process, we get 3 or 4 materials where one of the materials are very, very least important for the marketability. Then this material is called what? Byproduct. In case of paddy converted into rice, what do you get? Rice and rice bran. Is that okay? Rupees per kg. Clear? This may be say 50 rupees. This may be say 5 rupees only. Isn't it? Yes or no? The rice bun will be very cheaper. This is for whom? Human beings. This is for whom? Okay, cattle, cow and other thing, right? But it's a surprise. It is surprise. Okay, anyhow, I'll tell the surprise later. Now just see, for converting the paddy into the rice and other thing, there's a joint process. How can I split this cost for rice as well as rice bran? In case all the products are equal importance, no problem. How can we convert that? There's a format. In case the outputs are having unequal value, one may be insignificant value, how can we calculate? So, joint product as well as byproduct. Actually, what happens, gut healthy food. Most of the students, right, nowadays, eating now and then, here or there, whatever it may be, like paratha and whatever it may be, and feel restless sleep, and next day, you'll get stomach upset and all. So you have to go with this, what? Gut health food. Even that polished rice, is not good for gut health. Once I visited to the departmental store and like Geo supermarket, I found the rice burn sold at rupees 60 per kg. That's a surprise. Okay, now we become what? Cow and other cattle. So we become very powerful. So my cousin, who is in USA, came here once and had a chat with her. She told me, "We'll buy this and we'll mix 2 scoop with the rice, so that will be good for gut health." Okay. Now the same, which seems to be a byproduct, sometimes later it becomes main product also. Who knows that? Right? You'll now understand. Now what happens? No, A, B, C, three friends join together for a trip. Okay, tour trip. The overall cost for the trip being 3,000 rupees. Come on, how this 3,000 is going to be shared? Per head 1,000 naturally. Naturally, per head 1,000. That is called joint product. But C is very poor. His family will not afford spending this money. And A and B are very close to him. And he says, I can bring only 50 rupees. Now come on, tell me. How can you share? Will you share or will you not allow C to come with you? He is also your close friend. Join with me. Come, we'll take care of this. So, if he is capable of paying only 100 rupees, 3,000 minus 100 and 2,900 is shared by these two, 1,450, 1,450 and 100. This is called segregating the joint costs to various products based on their importance with the joint product equally as per their value capacity. Then one product seems to be not having the good sale value in the market. What we can do, whatever the sale value we can recover from that can be subtracted, balances shared by A and B. What happens here, you know? A, B, C. The joint cost being 3,000. 3,000. C says, I don't come, I cannot afford. Okay. Immediately A and B say, don't worry, come. Whatever the amount you can give, I will accept. C says, no, sir, I cannot give even single penny. Doesn't matter, you come, we'll take care of 1,500, 1,500. No. If I come with you for one day, I'm losing 100 rupees wages without which I cannot support my family. Now tell me. Oh my God. Okay, you can take 100 rupees. We'll now pay 1,550, 1,550. Okay. We'll give 100 rupees, settle to your family, come with us for the trip. We'll share 1,050, 1,550, 1,550. So 3,100 is received from A and B put together. 100 is given for C for loss. So this case will be considered as byproduct. Sometimes we may have some recoverable value. Sometimes we don't have the recoverable value. Sometimes we have the negative value also. How, sir? After joint process, we get product C. Cannot be saleable in the market. But I cannot keep in the factory itself. I have to discard. Maybe the C can be saleable for rupees 100. Okay. But what happens, you know, to sell, I have to send this out using the lorry. The lorry driver demands 150 rupees to remove this. So what happens? Ultimately, I get only 50 rupees. Whatever the amount you recover minus any expenses you spend for selling it should be subtracted. The ultimate value may be positive, may be negative. If it is minus 50, what happens? You know, 3,000 minus 50 becomes 3,050 is the overall cost for producing A and B. My intention is to produce only A and B. Anyhow, while manufacturing A and B, I got C also. Naturally, what happens? This 3,050 should be shared between these two, 1,525, 1,525. So, hope you will be now able to understand the difference between joint product and byproduct. In case of joint product, the products coming out after the joint process will be having equal importance to the market. Then the cost will be shared equally or NRV basis. Suppose one of the products seems to be least important in the market and the amount recoverable due to that is very, very lesser, insignificant or sometimes negative. Okay, what can we do? We can adjust that amount from the overall cost. And after that, after adjusting the amount recoverable from the byproduct, whatever the leftover will be shared by the main products. In the manufacturing process of Vijay Limited, one byproduct BP emerges besides two main products MP1 and MP2. So these are the main products. Okay. These are the main products. Clear? Now, now, raw material, wages, fixed overhead, and variable overhead. This is the total amount we spend. Input being 15,000 units. Overall cost to spend here being how much? How much is that? Is that 3 lakhs 40? This 3 lakhs 40 should be shared among the three products, where one being the byproduct. One being the byproduct. Is that clear? Now, average market price of MP1 and MP2 being 80 and 50. The sale price of this one being 80, the sale price of this one being 50. Byproduct is 25. This will be saleable at rupees 25 only. 25 only. Clear? 25. Okay, 3 lakhs 40. This value being 3 lakhs 40. There is profit of rupees 5,000 on sale of byproduct after incurring separate process charges rupees 4,000 and packing charges 6,000. 6,000 was released from sale of scrap. Sale of scrap. Now, what happens here? Joint cost we spent here being 1 lakh 40. 1 lakh 40 minus amount recovered due to the scrap value sale. Scrap value. How much amount recovered by selling the scraps? 6,000. Scrap is different. Okay. So 1 lakh 34,000 you incur. Whatever the amount you recover by selling the byproduct can be subtracted directly. Okay. Minus NRV of byproduct. Okay. What is the output? 1,600 is the output. Multiplied with 25. Come on. 1,600 into 25. 40,000. Anyhow, the byproduct cannot be saleable as it is. For selling the byproduct, we have to do some other expenses. What are they? Separate process charges 5,000 and packing charges 6,000. So we have to spend process charges separately after the byproduct emerged. We need to spend another 4,000 rupees for processing further. Apart from that, before sale, it should be packed further another 6,000 you have to spend. Okay. Now the ultimate value you will be getting here is 30,000. This is what about the NRV of the byproduct. After subtracting 1 lakh 4,000 is the joint cost meant for MP1 and MP2. Is that clear? MP1 and MP2. If only two products, no problem. Based on the sale value of these two products, you can segregate. Here we have the byproduct. We cannot equally segregate the cost to byproduct also, not capable of absorbing that. Whatever the capacity it has, no, that amount can be subtracted from your total cost. So what is the capacity of this one? 1,600 can be saleable at 25, though 40,000 is recoverable, but we need to spend another 10,000 rupees to move it out. So ultimately, we will get only 30,000 rupees. That 30,000 is subtracted. So 1 lakh 4,000 is the ultimate cost for the product MP1 and MP2. Now, come on, tell me. It should be subtracted or divided to MP1 as well as MP2. What is the sale value of MP1? 6,250 units were produced for MP1. Saleable at rupees 80 means if you multiply these two, what is the value you are getting? Is it 3 lakhs 40, right? Okay, sorry. Come on, tell me. What is the value of this? 6,250 into 80. Make it faster. 5 lakhs? 5 lakhs. Here, 5,000 units at rupees 50 each. 2.5 lakhs. This entire cost should be shared using this ratio. 3 lakhs 4,000 should be shared in the ratio of 5 lakhs and 2.5 lakhs. Otherwise, 2:1 ratio. So, 2 lakhs 2,667 1,01,333. Segregated. This is for how many units? 6,250 units. This is for how many units? 5,000 units. Now find out the cost per unit. Come on, tell me. What is the cost per unit? 32.4. You can give me 2 digits. 4, 4, 3. Next one. 1,01,333 by 5,000. 20.27. Okay. 20.27. Now we have to find out the closing stock value. What is the closing stock you have? 800 units, 200 units. This is cost per unit. You multiply these two to get the closing stock value. This is unit in rupees. 800 into 32.43. 944. 25,944. Here 20.27 into 200. 4,054 is the closing stock value. Is that clear? When we have the joint products, very simple. Based on the sale value of these joint products, you can find out the cost after segregating. When we have the joint product along with the byproduct, any amount you recover by selling the byproduct is subtracted from the overall joint cost. Thereafter, leftover cost can be shared for the main products. Is that clear? So I'll give the picture. In case of joint cost, what do you spend? Okay, what you have to do from there? Minus NRV of byproduct. Then you'll get what? Joint cost for main products. Joint cost for the main product. This will be shared between the main products using which method? Sales value ratio. Sales value ratio. That's all. Very simple. Yes, come on. Make a note of it. If it is clear, text me. We'll move on to the next one. Question number 4. Question number 5, sorry. C, raw material cost being 100, NRV being 120. What is the value as per AS number 2? Whichever is lower will be taken. If the cost is 100, NRV being 80, then 80 will be taken. What is called NRV? Final sale price minus expenses for sale. Expenses for sale. In case of work in progress, from there you have to subtract the further process cost also. In case of work in progress. In case of raw material, expenses for sale like brokerage and carriage outward and all these things subtracted. If the goods being the semi-processed form, the cost you incur for completing the remaining portion will also be subtracted to get the NRV. Using this raw material, you know, what will you do? What will you do? You manufacture the finished goods. You manufacture the finished goods. Now, the cost of finished goods being 500, NRV being 600. How will you value now? Whichever is lower will be the value of the stock. What is that? 500. If the same finished goods, cost being 500, NRV being 450, then what about the value? 450 will be taken. Now, what about the value of raw material? Raw material stock value. Cost being 100, NRV being 80. What about the raw material value now? What about the raw material value now? Cost or NRV, whichever is lower. But using the raw material, if I manufacture any finished product, if the finished product value is remaining more than its cost price, then the raw material value will be shown at cost only. That's the logic. Though raw material cost is decreasing, but the finished goods you produce using the raw material remains good value, no? Don't adjust the raw materials loss here. Raw material value may be down, but using the raw material you are producing finished goods, the finished goods value in the market is good enough. Any of the losses recovered. You no need to undervalue the stock. But in scenario 2, finished goods value is lesser. Then what about the raw material value? Then you have to take whichever is lower, 80 will be taken. This is the logic you have to understand. Raw material valued at cost if finished goods not sold at reduced price. If the finished goods not sold at reduced price, the sale price of the finished goods remains same. You no need to undervalue the raw material value. You can show the raw material value at its own cost. You no need to adjust for the NRV. That's the logic. Let's now try to solve this illustration. It carried 2 marks here. How will you deal with the following as per AS number 2? On 31st March 2014, the closing stock of X Limited includes 13,000 units of costing 14 per unit, but the current market price on the date being 12 per unit. Okay, so 14 or 12, whichever is lower, 12 rupees will be taken. So 13,000 units into 12 rupees can be taken. No problem here. Here we have not been given finished goods detail. If finished goods detail is there, then this should be adjusted. This should be adjusted, right? Now, Imran Company Limited deals in manufacturing certain products. It gives you the following information for the year ended 31st March 2013 with respect to the closing stock of these items. X, Y, Z, historical cost, NRV, compute the value of the closing stock. See, this question carries 3 marks in the examination. MCQ question like it was given 25 plus 15 plus 62, 1,02,000. This will be 1 lakh. As per the provisions, whichever is lower, 100 lakhs is valued, and the question is asked like whether it is true or false. No, it's not true. You have to find out the cost or NRV, whichever is lower for each and every item category independently, item wise. Item wise. So X separately, Y separately, Z separately. Between these two, whichever is lower 19. Between these two, whichever is lower 20. Between these two, whichever is lower 15. So 19, 60 and 15 lakhs. What is the ultimate value here? 94 lakhs will be taken as closing stock value. Item wise means same item purchased the same time, maybe 100 units. All the 100 units will carry the same answer. Not required to calculate for each and every unit separately. Okay, I purchased item X in January 1st. 100 units. For all the 100 units, the same rate will be applicable. Some totally different product, probably Y, then that may be separately calculated. And same X purchased 2 months later, where the market price is different, then that will be separately calculated. Is that clear? Item wise calculation must. Let's move on to the next one. Valuation of work in progress stock. Already I told you, solved already the illustration for the work in progress. In case of work in progress, you have to find out what? Cost or NRV. In case of cost of production. In case of NRV, sale value minus expenses on sale. Cost means cost of production will be taken. Cost of production will be taken. Okay. This expense is related to the sales and distribution, selling and distribution. Cost of production related to the material, labor, factory overheads and all put together. Up to the date of production, up to the point of production you have to add. Luxor Limited deals in 3 products A, B and C which are neither similar nor interchangeable. So all the products are totally different. So you have to calculate all the 3 products independently. At the time of closing of its financial accounts for the year ended 31st March 2015, valuing closing stock of the said products is to be determined. The details of closing stock of the three products given here. Cost of material, production expenses incurred. Selling expenses, no, it's not part of the cost. So if I add up these two, this is called cost of production. What happens to the selling and estimated selling price are? From the estimated selling price, if I subtract the selling expenses, this is called NRV. Hope you will be now able to understand. NRV is nothing but from the sale price, any brokerage and the carriage output, any expenses related to the sales will be subtracted to get the NRV. Cost of production is nothing but the cost you incur up to the production point. Probably you can consider the item debited in the manufacturing and trading account. The item debited in the trading and P&L account, debited in the P&L account will be a part of subtracting item from the sale price. This will be the P&L account item. This will be manufacturing account item. Anyhow, if you are studying the costing, anyhow, you will study later on where cost sheet will give all the details in explained with the explanation regarding the terms also, so it will be very clear. So cost of production includes the cost you incur up to the factory gate, factory overhead also. Thereafter, administration, selling and distribution cost, general administration will not be part of it. Now, cost in this case being 1,20,000, 55,000, 1,50,000. This is cost. What about the NRV? From 150 you have to subtract 140. 50 minus 5, 45. 180 minus 20, 160. Whichever is lower of cost or NRV is the closing stock value. 120, 140, 120 will be taken. 55, 45, 45 will be taken. 150, 160, 150 will be taken. The closing stock value of all the three items put together, 3 lakhs, 3 lakhs 15,000 will be the final value. Now, question number 8. Valuation of stock in trade based on cost or NRV, whichever is lower. Men's Limited purchased goods at a cost of 20 lakhs in October 2014. Till March 31st, 2015, 75% stock were sold. Cost incurred for purchased item 20 lakhs. 75% sold. Then 25% being stock. 5 lakhs. So the unsold stocks cost being 5 lakhs. The company wants to disclose the stock at 5 lakhs. They want to show the closing stock at rupees 5 lakhs. That's the question. Yeah, of course, cost being 5 lakhs. But the expected sale value being 5.5 lakhs, commission payable being 10%. What happens here? Do you want to take the sale value or NRV? You have to consider the NRV. NRV is nothing but sale value minus commission. So 4.95 lakhs will be taken. This is called NRV. So second point, NRV being 4.95 lakhs. Now what you have to do? What you have to take? So what the company's decision is not acceptable. Is that clear? Now let's move on to the next one. Valuation of raw material where finished goods produced and sold using such raw material. So we have raw material as well as finished goods both. In that case, raw material stock value will be taken as whichever is lower of what? Cost or NRV provided. Finished goods value goes down in the market. If the finished goods value remains standard or higher, no need to adjust for the raw material value. Right. So now the question is finished goods. Is the finished goods value decreases or remains same or increases? If the finished goods value decreases, raw material value is equivalent to whichever is lower of cost or NRV. If the finished goods value increases or remains static, then raw material value is equivalent to what? Cost only. You no need to undervalue based on the NRV. The cost of the production of product X is 450, which includes per unit of raw cost of material, means finished goods being 450. Cost of production of finished goods 450, which includes direct material, direct labor, overhead and all 250, 110, 90 respectively. Okay, the value is given. At the end of the accounting year on 31st March 23, the replacement cost of material is 210. Now this raw material value is 210. This is cost of raw material. This is NRV value of the raw material. Okay, NRV value of the raw material. Usually cost or NRV, whichever is lower, will be taken 210 only. Now, as finished goods given here, you have to verify whether the cost of the finished goods decreased in the market or not. There are 500 units of raw material in stock on 31st March 2013. Calculate accounting standards number 2, the value of the closing stock of raw material when finished product is sold at to 420. 420 means this option. Means finished goods value decreases. In this case, cost of the raw material being 250, NRV being 210, whichever is lower, 210 will be taken. Scenario 2, finished goods valued at rupees 490, compare with the cost, the finished goods cost is not decreasing, it's increasing absolutely. There is no any impact with the finished goods. Then raw material value will be taken at its own cost. You no need to undervalue based on the NRV here. Clear? Cross check whether the finished goods value decreases or not. If decreases, then raw material cost will be calculated based on the whichever is lower of two values, cost or NRV. If the finished goods value is not decreasing, don't bother about the adjusting the loss of raw material. Anyhow, you are going to recover that by selling the finished goods. Now let's move on to the next one. Now 10th one, valuation of finished goods, where we have been given the cost detail including fixed overhead. Fixed overhead will be divided by whichever is higher of actual capacity and budgeted capacity, actual production or capacity of production. Determine the value of the inventories in the following cases: raw material being 100 rupees, direct labor being 20 rupees, direct variable overheads, production related. Selling and distribution will not come here naturally. Fixed overhead related to the production. The normal capacity of 1 lakh unit. This is what about the capacity. So actual production detail is not given. So 10 lakhs divided by normal production capacity being 1 lakh. So fixed overhead being 10 rupees per unit. So you have to add this. The overall value being 140 rupees per unit. Number of units remains at the end being 2000 units. Then closing stock value 2 lakhs 80,000. Clear? Now, next question. In a production process, normally waste 5% of input happens always. It's very simple. 5,000 metric ton of inputs were put in process, resulting in a wastage of 300 metric ton. Cost per metric ton of input is 1,000. Okay. Cost being, okay, input 5,000 metric ton, rupees per metric ton being 1,000, total value of the input being 50 lakhs, minus loss is there. Come on, tell me. You have to subtract the normal loss here. What is the normal loss here? 5%. 250 will be subtracted. 4,750 will be the normal output expected. This 50 lakhs is for 4,750 units. Now come on, tell me cost per unit. 50 lakhs divided by 4,750, 1,052.63. Sir, why not 300, sir? This is based on the previous year experience. We found out that 250 units may be lost usually. If there is a loss beyond that, it is because of your carelessness, may be named as abnormal loss. The cost due to the abnormal loss will be borne by the person who is responsible for that. See, 100 ml milk costing rupees 10 rupees per ml or 1 rupee per ml, like we can have this. Okay. Now, what happens, 100 rupees. While preparing tea, 10 ml lost due to the evaporation. 90 ml will come. What is the price? By the time also the 90 ml cost being 100. But 100 ml, due to the evaporation, the actual loss rather than 10, it is 25, you get only 75. 100 ml cost us 100. What about the 75? Can I say the 75 ml cost being 100? No. Why the output is decreased from 90 to 75? Sir, I switched on and listened to your lecture seriously. I got diverted. Actually, it's not so possible. Anyhow, because of listening a very interesting lecture of you, I just forgot to switch off the stove. Another 15 ml milk evaporated. Then it's your careless mistake. That careless mistake will not be charged to the customer's hand. So 100 by 90 may be how much? 1.11. This is the amount you can recover. 100 by 75, what's the value? 1.33. You can demand the customer to pay only this much, not this one. The additional 15 ml losses due to the carelessness is named as abnormal. So you should subtract only the normal estimated loss, not actual loss. Hope now you'll be able to understand. So with that, all the theory over. Now let's, problems over. Now we'll discuss a small theory here. So with that, this chapter will be completely over. So after completion of the illustration, the chapter is very simple. Stock held for sale in ordinary course of business. It may be finished goods, work in progress, raw material, as well as consumable, 4 varieties. And sometimes machinery spare parts also you may have. Now the question is, raw material okay, work in progress okay, finished goods okay, consumable also okay. What about the spare parts of some machines. If the spare parts may be common, can be used for any machines whenever we are in need and the value is very insignificant, then it can be considered as inventory. No, sir, that spare parts is meant for the specific machine and we expect this will be used for replacing the machine's worn out part now and then periodically, then that will be considered as asset, property, plant, equipment. So if machinery spare parts, servicing equipment, standby equipment, the useful life being less than or 1 year will be considered as stock and valued as per AS number 2. Machinery spare parts, servicing equipment where the use is having the long life like more than 1 year, that will be considered as an asset. Asset will be studied under in accounting standard AS number 10, property, plant, equipment. So after that we'll go there, and there also I am referring this one. Any spare parts of the machine not being useful for more than 1 year will be considered as inventory, valued as per AS number 2, where I will discuss that part along with the AS number 10. The main objectives of this AS is determining the value and presentation of the same in the financial statement. To determine the value, this AS is helping you. How can we calculate the value, sir? So this point already we have studied. Raw material price can be adjusted against NRV only when the finished goods for which is sold below cost. Method of computation. Okay, method of computation. So how can you compute, sir? Cost value we have. Okay, methods of computation are cost formula. Cost formula. Understand that the stocks are not interchangeable. Are interchangeable. If it is not interchangeable, then specific identification method will be taken. If the stocks being interchangeable, then first you have to find out based on the actual spending you do, which is called historical cost method. Historical cost method. Or you can use non-historical cost method. Okay. What method I have to follow first, sir? Historical or non-historical? Can I follow one of the two options? No, you cannot follow one of the two options. First, you have to follow this one. If you are not able to determine the value of the stock under first model, then you can go for the second model. If you are able to determine the value of the stock under first model, you have been given choice to go for either FIFO method or weighted average method. Between these two, weighted average pricing method. Between these two, it's your choice. You can either go for FIFO method or you can go for weighted average pricing method. Historical cost and non-historical cost, that is not your choice. You have to choose historical cost method. If it is possible, no other doubt, you should not go the next one. If you are not able to follow historical cost, then you can go for non-historical cost. In case of non-historical cost, retail price method is usually followed. Either it may be standard cost or retail price method. Under retail price method, we have solved the illustration. What's that? Opening stock plus purchases minus closing stock minus sales. Value using the retail price value, find out the closing stock at the retail price, from that GP is subtracted. That is called retail price method. The last illustration we have seen, no, overall cost spent minus divided by number of units actually produced, subtracting the normal output. That is called standard cost. Some inflated cost will be there. Okay. Now, first choice goes to the historical cost model. If it is not possible, you can go for the second model. If first model itself okay, sir, then you cannot go for the second model. First model not possible, then you can go for the second model. Under first model, what method can be chosen, sir? FIFO or weighted average method? It's your choice. You can go for FIFO or weighted average method. The FIFO and weighted average method you might have studied at your foundation level itself, or you'll study pricing of material issue in your costing paper. No need to worry about that here. First in, first out method, weighted average pricing method, inventory calculations. Whether standard cost method or retail price method, that's your choice. What is called interchangeable, non-interchangeable, sir? Okay. So what happens, you know, in a departmental store, D-Mart and all, okay. Biscuits were there, biscuits, okay. Britannia biscuits or Mary biscuits, whatever it may be. This is 10 rupees, this is 10 rupees, this is 12 rupees, this is 12 rupees. These two are purchased in 1st Jan 25. These two are purchased in 1st March 25. Come on, tell me. This will have the lesser expiry life and this will still have more expiry life. March only, no. You now identify this stock is totally different than this stock. Then if you have the unsold stock of March item, it may be valued at 12 rupees only. It is not first in, first out method. So first item, this ones are, so I'm using the first in, first out method. If you purchase this one, I will price this based on the first in, first out method of 10 rupees. No, it's not interchangeable one. 12 rupees is for the Mary biscuit purchased on 1st March. What happens in petrol bunk? Petrol is there. This petrol, the bunk owner purchased at rupees 100 per liter. Sometimes later again refilled another some petrol at the rate of rupees 101 per liter. Can you ask him, sir, supply me 1 liter from this? All the petrol got mixed and messed. So we cannot identify whatever it may be 1 liter petrol, whether from here or here, it remains a petrol only. I cannot classify the petrol purchased at this rate and this rate. I cannot identify. Then it is called unidentifiable or interchangeable. In that case, we can use historical cost or non-historical cost method. Hope you will be now able to understand the cost formula determination. Cost formula. Hope now you will be able to understand. Now, this AS number 2 is not applicable for construction contract. There we have work in progress. Building is constructed. Currently, 50% building constructed. Hall over and up to roof over. First floor still pending. Can I consider this being stock? For the builder, it's a stock only. But for that, AS number 2 will not be applicable. For that, we have the specific accounting standard number 7. In case of service provider, no. Okay, service provider also, no. What's that? I have completed 50% syllabus. Can I value the remaining 50% based on AS number 2? No. Financial instruments, stock, shares, debentures, for that it cannot be followed. Livestock, agricultural and forest products, minerals, for that also not applicable. Not applicable. We have studied that joint products and byproducts also. Joint products, ratio of sale value at split of point or after split of point will be taken. So at split of point, after split of point, all these things you will study along with the costing paper, not here. So you will be studying a lot of things in different accounts, costing, management accounts, even in your foundation level, right? You might have studied various areas, but here standardized. What you follow, you are going to given in this accounting standard, it's given as a systematic format to be followed. So it's very friendly. These topics are very friendly. Now, by the year end, what you have to disclose? Cost formula. We have been given cost formula, right? Specific identification method. In case non-interchangeable. In case of interchangeable, you have cost model, historical cost model, non-historical cost model. Under historical cost model, FIFO and weighted average methods are there. In case of non-cost model, non-historical cost model, standard cost or retail price methods are there. What method you follow in your accounting? You have tell me. Otherwise, the financial report reader cannot understand what method. Similarly, in case of depreciation, WDV method or SLM method, what method you follow? Unless you tell, how can I understand this? So disclosure is nothing but whatever the policies, methods you followed, you have to intimate that. That's what about the case here. That is called disclosure. And also you have to give the classification of inventories with the carrying amount, the value. It may be classified as raw material, finished goods, work in progress, stock in trade for retailers, loose tools, stores, spares, and others like consumables. These are classifiable. Now, finally, we'll get back to the cost determination. In case of determination of cost, whichever is lower of what? Cost or NRV. Okay. Because we are applying the proof. Write the examination, you expect the result may be favorable, not favorable. What do you have to do? You have to come and attend the class next time immediately. Isn't it? That's what our prudence concept. If you are very confident, out of 400, you will definitely score 300 plus. Even worst scenario of valuation, then happy you can plan for the next group, right? So that's what about the prudence concept. So that's why here, if there is even small doubt, the value may go down, then cost or NRV, whichever is lower will be taken. So cost, that you know, NRV, sale value minus selling expenses. In case of work in progress, you have to subtract the cost of further process. This is called NRV in case of sale value. In case of cost of production up to the factory gate, manufacturing account, you might have studied the final accounts at your foundation level. Final accounts for the manufacturer, you prepare the manufacturing account, trading account, P&L account. All the costs related to the factory debited to the manufacturing account like factory rent and factory depreciation, machine depreciation and all debited to the manufacturing account, also forming part of the cost of production. Up to that part will be considered as cost. Direct material cost, cost of purchase, purchase price, carriage in, any tax being non-recoverable will be addable. If any rebate, discount, trade discount, tax you paid can be getting it back from the government, duty drawback like should be subtracted. This is what about the direct material cost. And conversion cost. Conversion cost is nothing but other than the direct material cost you incur for manufacturing the finished goods is called conversion cost. Direct material converted into finished goods. Here, direct labor, direct expenses and factory overhead will be taken. Factory overhead will be taken. Okay. Now, factory overhead in case of variable cost based on the actual production capacity will be taken. In case of fixed overhead, whichever is higher of what? Normal production or actual production. Capacity or actual, whichever is higher will be taken. So, you have studied. So, add these two will be considered as cost of production in general. We have solved the illustration based on these assumptions. Apart from that, three more costs are also be addable. What are they? You might have studied the taxation also, interest calculation in case of PGVP. Okay, cost incurred up to the date of put to use of any asset will be capitalized. The same logic will be applicable here. Okay, interest on borrowing. Okay, if stock takes substantial time to get ready for sale, then the interest on borrowing will be addable. In case of wine and some other items like basmati rice, old basmati rice will be very costlier. New basmati rice or any rice will be very cheaper. Okay, will you buy new rice or old rice for your cooking? Old rice. Why? Why? Will you purchase the new rice or not? You don't purchase. You purchase. When do you purchase the new rice? During the Pongal. So during Tamil festival Pongal, you will purchase a new rice because immediately it will become Pongal like. So once for a while you can eat the Pongal like, and daily it's not possible. So you make it old and then you'll eat that rice. So you keep all the basmati rice stored in the godown. At least for 2 years it's seasoned and 2 years later it's sold. You purchase the rice for 1 lakh rupees and you kept in the godown for 2 years. For the 2 years, at the rate of 10% interest you are paying per annum. So for 2 years, 20,000 rupees you spend. After 2 years only, you plan to sell. Okay, 1 lakh plus 1,20,000 will be considered as the sale price. So if the stock requires some gestation period to get it ready for sale, during that period, if you are paying any interest, that will be forming part of the cost. In case of wine, you need to keep in brewery for 10 years, 15 years, 100 years. If it is for 1,000 years, then it's very costly. See, okay. So you no need to be drunken for that. You can be teetotaler also. For the additional information, you can go and search the price of the liquor and all wine. So during the period of storing, you may borrow and you are paying the interest. That interest can be capitalized, means part of the cost of the stock. And the cost incurred to bring the inventory to present location, which is nothing but carriage, will also be considered as addable item. And you get the patent for manufacturing raw material, the finished goods, whatever it may be, or manufacturing. For that you get the technical know-how, or you purchase the patent to manufacture. The patent and technical know-how cost will be also forming part of the cost of production, can be addable. What cannot be addable? What cannot be? Administration cost, selling and distribution cost, interest and penalties after the stock ready for sale cannot be capitalized, and storage cost, if you are keeping that in storeroom or in warehouse for a long period, remains unsold. During the period, whatever the storage cost will not be capitalized. Abnormal cost cannot be includable. Any in exchange difference, foreign exchange difference, if there is any cost, profit or loss, that should also be not considered. Hope you will be now able to understand what are the things are falling under cost and what are the things are considered for NRV. What should not be taken in.